Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to do something different. We're going to review the IPO of Domino's and Google. And I'm going to show you exactly how Domino's in 2004 with a simple $10,000 investment would have grown over 5,000% to be $550,000, outperforming Google, which at the time was the leading and hot IPO. It's a few classic value investor techniques that I'll show you how to identify, and we're going to benchmark it here today. You ready? Let's get to work. Okay, before we dive into the financial information that was given to us at the IPOs, I just want to take a second and look at the chart and see what we notice. So first of all, Domino's is in the blue chart, Google is in the orange chart. Google is kind of like a steady stream going up, right? A steady state company that when you IPO'd with much fanfare and quite a premium. And that premium has kind of bored out well in that the stock has continued to go north very regularly. Domino's, on the other hand, IPO'd at very low fare, very cheap multiple, which we'll get into, and it kind of got out of the gate and stumbled. And then over time, rebounded to phenomenally grow. And what we can do is we can kind of see what happens here when a stock stumbles, but you don't sell it. Because the biggest thing here is the time it took to get there. This is 17 years that you would have had to own the stock. And that's a long time that not many investors ever maintain. It's one of the things that I try to enforce in this channel is that you're picking a horse for 20, 30 years, and you really need to stick to that because over time is when the compounding truly happens, and flipping in and out of a stock or following some red or green chart or line, you're going to pay taxes every time you sell, and it doesn't give the chance for the investment to really compound. And what you can see here is really either stock, had you bought it and held it, you would have done phenomenally well. You would have crushed the market. It's just that Domino's had a little bit safer of a play because the growth assumptions that you would have had to underwrite when you bought the investment was a whole lot less. And we're going to get into that here in a second. But I just wanted to appreciate the time that it would have taken, you had to wait to get these returns is over 17 years, and most people, including myself, had a hard time holding Google this long. Now, I did buy Google at the IPO. I made a little bit of money. I thought it was a hot shot, and I sold it. And then I didn't buy it for another decade. So sometimes when you make a little bit of money flipping a stock, fine, but you miss out on a tremendous amount of growth by simply doing nothing. And that's what I've tried to get through this channel over the years is that you pick an amazing company, you invest, and you watch them, and you go live your life, and you stop trying to flip in and out of the stock, which creates movement, but not necessarily progress. And for me, my lesson was huge. I bought in, I flipped it, made a little bit of money, but then thought because I sold it, I must go look elsewhere for another investment to make that kind of return. But really, you're never going to be able to replicate a Google. I should have just left my money in there or bought more and let it ride. But instead, I spent a long time looking and chasing other investments when all I would have had to do is just leave my money alone and it would have continued to earn money for me. So real life lesson for me was buy a phenomenal company and hang on to it. But let's check out the details behind how Domino's outperformed Google and whether or not we would have been able to identify it using our 5 key attributes. Now, the 5 key attributes that we use here in this channel to evaluate all stocks are top line revenue growth. You got to have it. EBITDA growth. We want enterprise level earnings growth must be growing. We have strong free cash flow, low debt, and a well-priced stock. Well-priced stock is basically a stock that through a conservative forecast will outperform the market. So we put a conservative forecast going forward and we look at the rate of return that we get if we bought the stock today and held it for that conservative growth. Does that investment rate of return, the IRR, outperform the stock market, which is averaged 10%? Do we beat that? That's our definition of a well-priced stock. Okay, let's get to work and dive into the numbers. All right, so here we got the numbers for Domino's. These are millions in USD. It is much more abbreviated than what I normally give you, which is a full 10-year look. Here, we're basically looking at the information that was provided at the IPO. They give 3 years of data. This is one reason IPOs of brand new companies like Snowflake and like some of the other companies that have just IPO'd are very difficult to value because they don't have long operating history. Domino's actually had a very solid long-term operating history. They provided more detail than the 3 years in their S1 when they went public. So you can get a better feel for the movement of the business right away before having to watch it over time in the market. I like that. And that's, if you are going to buy an IPO, you got to find one that has the history of operating so you know how the business is going to perform and not just guess once it gets public. But nevertheless, $517 million of revenue in 2002, 5 to 20, 530. So it's growing. That's weak single-digit growth, but it's still growing and meets our checkbox of growth. EBITDA 186, 189, 203. So again, growing, weak, but growing. Also positive on the enterprise level earnings. Checks our box for 5 key attributes. So both of these qualify. Let's take a look at debt and leverage. Now they had a lot of debt, $781 million of debt. But against $200 million of earnings means a leverage ratio of 3.8 times. Now we look for less than 3, but it's not a hard rule. You just don't want 5, 7, 10, 11, right? 3 to 4, fine. It's not great, but it's not a showstopper. In terms of enterprise value, if I take this debt, they had no excess cash. They had an market cap at the time they went public, about $875 million. I add these two up, I get the enterprise value. Now, the enterprise value is the value of the entire enterprise. Think of a house. The retail price of a house that you buy it at is the enterprise value. You go to a bank and borrow a mortgage, and then you put down your down payment. Your down payment is the market cap. The debt is the mortgage. This is the debt. They combine for the entire value of the home. The business is no different. Market cap is the equity, down payment, trades in the stock market. The debt piece is what you borrowed in the bank, enterprise value. That's what enterprise value is. So just make sure you always keep in mind the enterprise is both debt and equity. But overall, the value of the business is $1.6 billion. It's a cheap business. It was traded, IPO'd at 8 times earnings. So in other words, it's an 8-year payback. If there's no growth, which the growth is weak, you would expect that, you would have, had you put the money in, the business would have paid for itself in about 8 years, meaning the annual earnings, roughly 8 years of earnings equals 1 enterprise value. That's what that means. So that, in terms of, for us, is a nice, cheaply valued company. If you give a little bit of growth to this in a forecast, it will probably pencil out. But let's take a look at free cash flow. Okay, so now free cash flow in 2002, $104 million, 103, 113. So it's growing in line with EBITDA. It's weak, but it means that EBITDA and free cash flow from operations are both growing. So that means the accounting world is doing their job. There's no, they're not massaging the numbers because this is going up weekly, EBITDA is going up weekly. That's generally when the two statements are in line, you would expect that. CAPEX, they don't put that much CAPEX back. They're a franchise, right? So they're franchising out the Domino locations. They're not building them themselves. They don't have a whole lot of CAPEX. So most of this money flows through to free cash flow. Now, there's one caveat. There's a negative $881 million of debt payment here, which they used IPO proceeds to pay down debt. And I've zeroed that out because it was kind of a one-time deal, and I wanted to get a feel for what the raw cash flow was outside of the one-time down payment. So that's a little caveat that I've made a change here. But when I flow that through and assume that they're not going to pay down that giant chunk of debt every single year, right? It was kind of a one-time deal. I'm left with $76 million of free cash flow. There are 49 million shares outstanding. That's $1.55 in free cash flow. It IPO'd for around $18. And what does that mean? That means a free cash flow yield of almost 9%. Now, if you are a fan of this channel and you've been watching lots of episodes, there are very few times that we find stocks that yield on a free cash flow basis as high as 9 or almost 10%. And whenever we do, in fact, the return has been very high on those stocks, and I've recommended those stocks because this free cash flow yield means basically if the stock does nothing, I'm going to earn 8.5%, 9% of my money. As this continues to click out cash as dividends or buybacks or so forth, that means the growth of the stock only has to be 1.3%, and I equal the stock market's average return of 10%. So if top line earnings growth is growing weekly, but you have a strong free cash flow yield, you will most likely beat the market over the long run. That's been my thesis. That's what this channel's thesis is over a period of time. And I think that would have borne out here for us as rational, free-thinking investors. This thing has top-line revenue growth. It has earnings growth. It has strong free cash flow. It has low debt. And I think it would have penciled out on a IRR basis. So I'm going to give Domino's a good ranking at the IPO. All right, now let's take a look at Google and the information Google provided when they IPO'd. So here, 2002, again, they IPO'd in August of 2002, about $50. That's split adjusted. I think it was slightly higher, almost $100 when they actually IPO'd in 2002 daytime, that era, but split adjusted is about $50. So 2002, $440 million of top line revenue, quickly jumps 1.4 billion, quickly jumps 3 billion. So rapid growth on revenue. EBITDA, 215, 397, 789. Really fast, both top line and earnings growth for Google. So we would expect a much higher multiple on the stock when it IPO'd. Because of that growth, people are willing to pay forward more for the earnings. Let's take a look at debt. Debt was essentially nothing. $45 million for a company that's printing on earnings $800 million is going to be a zero on the ratio. So they have no debt. Fantastic. So they IPO'd, strong top-line revenue growth, strong EBITDA growth, no debt. That's a great start. Market cap was about 18, 20 billion. Depends on when you measure this the IPO price. Because the first day or two, it really ramped up. So it depends when you strike that. This could be 18, it could be 23. I've seen different numbers. But I've got 18 here with my math. It's close enough, 18, 20. But that means it IPO'd for about 23, 22 times EBITDA, which is remarkably different than Domino's. I'll remind you, Domino's IPO'd at 8 times earnings. So that means I wait 8 years on a weak growth. The company has paid for itself. And while I did that, I got a yield of almost 9% annually. Here, I'm IPOing at 23 times, so assuming weak growth, I have to wait 23 years to get my money back. Now, obviously, they grew a whole lot faster, but it's how fast do they grow relative to how the premium you paid today. And that's where we're going to find that the rubber meets the road. But I think this overall is still a very positive site. This is a bit of a premium, certainly not in today's market. Today's market, this is a reasonable number for a growth stock. We've got things that are 60 times earnings right now. But I don't want to derail this thing. Let's keep going. Let's look at free cash flow. All right, free cash flow, $155 million in 2002, $395 03, and $977 in 2004. Again, strong growth. That is dovetailing nicely to the EBITDA growth, so you know that the income statement and the cash flow statement are lining up directionally. The accounting team is doing a good job. Good job, accounting team. CAPEX begins to get heavier as cash flow increases, but it's never more than what they have in the course of a business. So what this is for those that are new to the channel, and I didn't cover it when I did the Domino's video, but cash flow from operations. This is the cash money. Life goals. This is the cash money that is made at the end of the year by operating the business. Forget the income statement for a second, because there's all kinds of non-cash numbers in the income statement. This number, that's $977 million of cash money that hit the bank account. And what I like about that number is that auditors can track it because you have a third party like a JP Morgan, like a Wells Fargo. It's another institution that the auditors, when they're auditing Google, will contact and say, hey, JP Morgan, Google's telling me that at the end of their calendar year, they had $977 million in the bank. Now, this is cash flow on a bank account, but it's an analogy. Can you verify for me that actually happened? And the bank will say, yes, auditors. Here's JP Morgan's seal of approval. That's why we like cash, because cash is tangible and it can be verified by a third party as opposed to revenue, which can be maneuvered depending upon how management wants to determine what revenue how to recognize revenue. So a little accounting nuance here, but that's why we like the cash flow from operations. But I digress. So $977 million of hard cash money came in the door. They peeled off $319 million, put it into the business for server farms, for new office complex, and so forth. And what was left, $658 million of jack left over that they can just sit on the balance sheet, buy back shares, pay dividends with. That's that. Shares outstanding, 193 million at the time. That's $3.43 a share. At a price of $91 is when I was at the end of the fiscal year. That's December of 04. $90 a share. That's a $3.8% free cash flow yield. So yield is much, much lower. Let's go back. Take a look at Domino's. So Domino's 8.7% yield. Why is yield high? Well, yield and multiple are inversely related. The higher the yield, the lower the multiple you're going to pay. They're just inversely related. But you got a high free cash flow. That means Domino does not have to have much growth for me to beat the stock market. Whereas Google, because the yield is so small, I need a whole lot more growth to beat the stock market. Now, they're both going to beat the stock market, but the growth relative to one another, that's what happens here. So let's recap the 5 key attributes for Google. Number 1, top line revenue growth. Yes, it's strong. Number 2, earnings. EBITDA is growing and strong. Number 3, strong free cash flow. Absolutely. Number 4, low debt. Yes, it's 0. And number 5, well priced. Yes, I think it is well priced. I did buy the IPO, so I'm going to say it's well priced because I bought the IPO, even though I sold it very quickly after that. I'm an idiot. But the thesis was right that with a forecast, you would have been able to pencil out enough return to beat the stock market. So for this reason, we also give Google a good at the IPO. Now, let's check and see where they are today, and then we'll look at a comparison between the two. Okay, let's see how Domino's and Google have performed to date and bring the date information current. So, by the way, I don't think I mentioned it. Domino's IPO'd in July of 04 at $14 a share. Google was August, so very, very similar in timing. Great beginning start point for each of them. But we'll bring it current. So currently, last fiscal year, 2021, for Domino's, $4.1 billion of revenue, $768 million of EBITDA. Strong growth. What's that? Like 3.5 times growth of EBITDA over that period of time. Debt, $300 million on $768 million of earnings. That's a very low debt multiple, 3x. So they've actually grown into their debt. They borrowed heavily here. They invested that wisely, and over the time, they were able to use this borrowed capital at a very high rate of return, such that now earnings are much higher, debt is lower, and the ratios come down. But low debt, they have about $100 million of cash, excess cash on the balance sheet, and about a $15 billion market cap. When I add the debt, less the excess cash, and the market cap, I get a $15 billion enterprise value, and it's currently trading at 20 times earnings. So what does this mean? This means that the market multiple expanded tremendously from 8 times to 20 times. That is more than doubling the market multiple. Means every dollar that Domino's earns in earnings gets 2 times its value in the stock market, which is stock that you would have owned if you bought the stock. All right, let's look at free cash flow. Same story for free cash flow, $592 million of free cash flow, $88 million of CAPEX, a little bit of debt payment, $460 million of free cash flow. It's basically a 5x, 6x actually. Almost 7 times 7 is 49. So almost 7 times on your money over this 17-year period of time. Shares have shrunk. They've been buying back shares over time. And you've got $11 free cash flow and a yield of 3%. So the yield has come down as prices moved up. That's Domino's. Let's take a look at Google. Google's top line revenue for 2021, $182 billion of revenue, and $55 billion of EBITDA. Very, very strong, monster growth here, right? From 789 million to 54.9 billion of earnings. Absolutely a behemoth. Debt has also grown to $14 billion from essentially zero, but excess free cash flow at $110 billion is just ridiculous in size. It's so big. $1.4 trillion in market cap, and I add the minuscule debt less the cash. This becomes a negative number. This subtracts from market cap, and enterprise value is less than market cap because they have so much free cash, excess cash. So they get $1.4 trillion market cap, enterprise value, and a 24 multiple. So here the multiple is basically the same, 22, 24. It's very close, roughly the same. So no market multiple expansion on Google. When we look at the free cash flow itself, $65 billion of free cash flow, very good, very close to EBITDA. They're peeling off roughly a third of that in free cash flow, CAPEX. I'll give you the titles here so you can see, of CAPEX. So that's what they're reinvesting back into into YouTube, into Android, into the cloud servers, all their infrastructure that they're going through. They're reinvesting that kind of cash for growth. Small debt borrowing, it's nothing, but they did borrow some cash. $54 billion of free cash flow. Shares outstanding are actually more shares than they started with. For a free cash flow per share, $77. At $2,000 roughly price per share gives you a 3.7% yield. Not a bad free cash flow yield, but it's definitely low, and it's roughly the same what they had when they IPO'd. So the market is not giving extra value for the earnings because the story in Google hasn't changed. It IPO'd at a growth story. It is today a growth story, and that's why the shape of the curve is kind of very smooth and level. They also issued shares between IPO and now. They have not been buying back shares. So this is added dilution. That means that you get, as a shareholder of when you bought the IPO, you're getting a smaller fraction of this number here. Even though that number is growing very, very rapidly, the dilution lowers your percentage share of that number and weighs on the return. Let's summarize these two quickly on an annual basis, and I think this is going to make it very clear what happened. They IPO'd at $90 a share, and over time, over the 17-year period, this is December ending values, the price has gone up. Why? Because earnings have gone up. No big deal, okay? It's gone up. Your shares, your $10,000 investment in 04 would have given you 191 shares. Well, in the end, you still have 191 shares. So you didn't get any more shares. The price went up. Your value goes from $10,000 to $394,000, or a rate of return or a growth rate of 3,900%, almost 4,000%, which is a phenomenal return. Don't get me wrong, but it's only price driven. There's no market multiple expansion, and you don't gain any shares through share buyback or a dividend. So really what you started with is what you ended with, and it's only on price movement that this stock gave you value. And thankfully, when you bought the growth story, it panned out. There's lots of companies in this world where they give you a growth pitch and it just doesn't pan out. And so you're left with kind of nothing, because if growth falls short, you have no dividend, you have no underlying share buyback, nothing you can rely on to just give you a little bit of return to eke out something while you wait for the big aha moment. Google happened to have the aha moment kind of all the way through. Good for them, but there was no extra benefit there. Let's take a look at Domino's. Okay, so Domino's is a different story. Domino's IPO'd at $17 a share over the 17-year period of time. It went from $18 to $380 a share. But during this time period, it absolutely collapsed to a low of $4. So they cut the dividend for 4 years. Had you held out, they would have given you a nice dividend for waiting, catching up for the periods that are missed. And then the dividend continued from thereafter and continued to grow. Now, if you take that dividend and you tell the broker, your broker exchange, to buy more shares of the company, to reinvest the dividend, then what happens is your share count grows. You started with 560 shares when you bought your when you put your $10,000 investment in. And then every time you got a dividend, you bought more shares, 569 to 560 to 569, 579, it grows. You got a special one-time dividend, $13.50. We bought more shares with it. And you continue to jump. And the cool thing is, as the share price falls, it gets super low, you're buying shares lower than the IPO price right here. And then when it really starts rebounding, right, and growing, you now have more shares than you started with, almost 3 times, slightly less than 3 times the shares you started with. And that is helping magnify the return. So what happens here is you get a earnings growth, you get share expansion, and you get multiple expansion. That's the trifecta that I talk about on my channel, right? We typically say share buybacks, but in this case, you're reinvesting, you're buying more shares. They also did share buybacks, as you saw earlier. So it's kind of the same thing. You've got earnings growth, which we've seen over the period of time, modest earnings growth, not huge. It wasn't what Google experienced. It was much more modest, but still there. You had share expansion, share buyback, or you reinvested your shares. And then the multiple almost tripling from 8 to, I think I said 22. That means that every dollar of earnings that they were generating back then, they're now getting 2 times more or 3 times more credit for. And that, the combination of that, produced this result. And you can see it here, the dip in the stock price, the drop, but you're collecting that special dividend, you're reinvesting, you're buying at the low. And then when the market wakes up to the earnings, you get both the increased earnings growth, which means upward sloping. You now have more shares, so your total portfolio has more, and the market multiple begins to expand from 8 to 22, and you get a parabolic turn. That's the trifecta. That is how a simple $10,000 investment would have turned into $550,000 from Domino's. All right, this has been Rational Investing. I hope you really appreciate this value lesson in buying free cash flow. You don't necessarily need to go for the big growth story. Google panned out this time, but there are lots of stocks that don't. The big lesson here, A, hit the trifecta. B, the 5 key attributes seem to indicate, in this case, that it could work. And then C, you need a lot of time. Most investors that have owned stock for a long time have done well. Even if some go bankrupt in a diverse portfolio, you will have your winners will much outweigh the losers over a 10, 20, 30-year period of time. If you want to learn more how to do this, I teach a course. Check out my website, cashflowinvestingpro.com, where I give you an Excel model. I walk you through Apple's 10Ks. In fact, Apple did just this exactly the same thing. If you look at Apple's history, there are periods of time when it traded at single-digit EBITDA numbers and high free cash flow yields. Had you bought the stock then, you would have had massive earnings growth, you would have had massive market multiple expansion, and share buybacks would have given you the trifecta. There are other examples like Microsoft, which are all both growth names, but if you time it right and you look for the right factors, they can also be growth stocks. So this idea of like, I'm a growth or value investor, I think is hooey. I think you're a cash flow buyer, and you can absolutely find phenomenal growing companies that meet these criteria and make excess returns. So check out the website, cashflowinvestingpro.com, where I teach a course. I teach you exactly how to build forecasts, how to go through the 5 key attributes, how to identify a handful of stocks, say 20 to 30, that are in your portfolio that you know well, that you read the 10K every single year, that you watch management, and you're diligent about how you run that portfolio, and you let it ride for a long time. Go live your life just checking annually, and you let the stock market do the work for you. Let the company do the work for you. Much like I should have done when I just would have held on Google. Those guys would have continued to make me money. Instead, I, at the time, believed in the flashing green and red lights, that's how you make the money in the stock market. And what I realized is all you're doing is you're paying commission. They had commissions back then. And B, you're paying taxes, 20, 30, 40%, depending on the short-term gain, to the government. And then you're reinvesting the money with less than you started with. It's a waste of time. Don't bother doing it. Pick the right stock, hold it forever, get rich slowly. That's my motto. #life goals. All right, guys, I'm out of here. Thank you very much for watching the channel. This is Cameron Stewart, Rational Investing. Take care. Bye-bye.